You got a whole bunch of cereal on this floor. Can you get it up for me, please?
Okay. All right, let me make sure that we're not getting double sound. Okay, we're live. All right. So, good morning, everyone. Welcome back to week 2 of our underwriting series. Last week, we rewired how investors think. This week, we're learning the language of numbers without intimidation. Hold on. YouTube, forgive me. We got to run it back. Good morning, everyone. Welcome back to week 2 of underwriting series. Last week, we rewired how investors think. This week, we're learning the language of numbers without intimidation. Because here's what happens. Most people don't fail at underwriting because they're bad at math. They fail because they don't know which numbers matter. So today, I'm going to simplify this so clearly that numbers feel like tools, not threats. Numbers are not scary. Confusion is. So let's start with something simple that changes everything. Here are 3 numbers people consistently mix up: price, value, and entry fee. If we can separate these 3 correctly, underwriting becomes calm instead of chaotic. So let me start by asking y'all, what is the definition of price? What is price? When y'all hear price, what is price to you?
What something cost.
Yes, the cost of something.
Or what
Now,
it's listed at, rather.
Right. Price is what the seller wants. Tevin hit it on the nail. And here's where people get confused. They treat price like it's the truth. It's not. It's a request. Even like you said, Tevin, price, the cost of something. When we go to the store, yeah, the price is listed there, but that doesn't necessarily mean that's what you have to pay. You can negotiate on that price, okay? So where do sellers actually get price from? Anybody?
The market, what they think is worth.
They make it up.
Emotional.
Yes. Emotional, the market, Zillow, Redfin, what their neighbor sold it for, what they owe, what they need, what they feel it's worth. Sometimes they do use real comparables. Sometimes they don't. And like Tevin said, sometimes it's just emotional. Think about someone that's owned their house for 30 years and they absolutely love it and their family grew up there. Of course, they're going to assign a higher price to it. Now, let's go a little bit deeper, guys. Think about for sale by owners. Often they don't use structured comparables. They might just say, I need 500,000 because that's what I want to net after taxes. I owe 470 and I need to walk away clean. Or I'm behind and I need enough to catch up. Or I have a reverse mortgage and I can't sell below this payoff number. So a lot of times when we see for sale by owners that are listed too high, they don't understand, pricing based on comparables. You have to figure out what's the real issue of why they listed their home at this price. How did they come to this number? And usually you'll find their real pain point. So now the price isn't really based on the value. It's based on their situation. Price tells you about the seller. It does not tell you about the deal. Everybody good with that?
Yes.
All right, well, let's talk about value because value is different. And Tevin touched on this a little bit. Value is what the market says the property is worth. But who is the market? What does that actually mean? Does anybody know what people mean when they say value is determined by the market?
Okay, it's my house is a 3-bedroom, 2-bath. Every other house in the neighborhood, similar to mine, is worth X. This is what they're valued at when they're selling. This is what other people are willing to pay for it. So therefore, that is the value. Unless your house stands out within those, that is the value.
Right. So just like you just made a kind of differentiator. So even though all the other houses may be a 3-3 and theirs is a 5-4, it's going to be a different value. But who at the end of the day, Tevin, determines the value of a property?
The buyer.
Yes, that is so key. And let me tell you why. The market is not Zillow. The market is buyers with money and financing. The market is a qualified buyer that can actually follow through with purchasing your home. The market determines value through comparable sales, active buyer demand, interest rates, inventory levels, lending conditions, buyer confidence, inspection tolerance, appraisal standards. So when we say the market, what we really mean is what buyers are willing to pay and able to pay under current conditions. That's super important. And let me give you guys an example why. Okay, the value can shift without the property changing at all. It could be in the same exact location. We're talking about the same house, same square footage, same condition, but in two different environments. One market has low interest rates and limited inventory. Rates are 3%, very little houses available on the market. A bunch of buyers have now been approved. Multiple offers are happening. People are waiving inspection. Appraisal gaps are covered. Now, this home might be worth $1 million in this market because multiple buyers can afford it and they're fighting for it. In that market, the value of the home is $1 million. Now, in the market we're currently in, rates are at 7 or 8%. Inventory is building. Houses are sitting. Buyers are cautious. They don't know what's happening with the government. Inspections are a must. Appraisals are even stricter because banks don't want to be over leveraged. Sellers are constantly reducing their prices. Now that same house might be worth $800,000 in 2026 market. And now the buyer wants it in pristine condition. They want concessions, they want repairs, and they want certainty. The property did not change at all. The market and the environment did. Value is dynamic. Price is static. Entry fee, now that's personal. Before we get to entry fee, y'all, do you have any questions about price or value? And do you really understand the difference now?
Yes.
Do y'all hear people mix those up a lot?
Yeah. All the time.
And it's really, really important when we're underwriting that we know which one we're talking about, because the seller may give us a price, but what we're trying to figure out is the value a buyer will pay for the property. Because if we have no buyer that will pay that price, then that property's value is not equal to the price. Okay, so what about entry fee, y'all? We need to know entry fee for traditional and creative deals. And entry fee is the way that we actually get to the number that determines if it's a deal or not. So what can be part of the entry fee, y'all? And this is what it costs you to enter the deal.
Closing costs, transaction coordinator. Those are typically the ones that I have noticed. Sometimes, well, not sometimes, mostly EMD as well, earning money deposit. So those are typically the three additional on top of, say, the entry fee is 10,000 plus closing cost of whatever state you're in, plus the transaction coordinator. It's either yours or theirs, and then whatever the EMD is. So those are typically what I see and notice.
Okay, very good. Max, you have any entry fees that you've seen when we look at properties, or anything that any of your investors may have mentioned that you have to watch out for? There are quite a few, guys, that we always forget about. And one that's always going to usually be there is some form of repairs. Then for our fix and flippers, going to be holding cost, reserves, especially because they have to pay, for their loan or whoever is financing the flip over the months that they are renovating it. So reserves, even buy and hold investors have to account for reserves until they can get the property rented out. You have insurance, you have utility deposits. There are permit fees when you have to do any renovations or upgrades for plumbing or electrical. Some of the properties and most of the ones we see now have HOA balances, back taxes, points paid to the lender that finance the deal, or even a private lender fee. You have attorney fees and legal setup. You may have arrears or back payments on a mortgage, and you may have a servicing fee set up to make those payments on a seller's behalf. Now, that's a lot of stuff that people usually don't account for. But the person who's buying the deal on the other end has to account for those costs. And this is why we see a lot of investors in the red. And this is why we always need larger margins than we think in the deal, because we haven't accounted for all of those little $1,000, $2,000, $3,000, $6,000 costs that that investor on the other side has to account for. So is everybody good with this before we go to an example? And if you guys have any questions and can't unmute, feel free to drop them in the chat. Okay. So some deals look cheap in price, but expensive in entry fee. And some look expensive in price, but very low entry fee. So again, y'all, it goes back to week one, determining who this buyer is. Who is this property or this deal for? So examples for traditional versus creative entry fee. A traditional purchase might require, like Tevin said, a down payment, closing costs, lender fees, inspection, repairs, and reserves. So if the home is $200,000, what's 20% down of $200,000 home?
20%.
20% of a $200,000 home?
40.
40 grand, 40,000. Same price with 3% down is much, much lower. It's a very different entry fee. So 3% down would only be a $6,000 entry versus a 40K entry. That's basically the difference between an FHA loan and a conventional loan. Okay, now let's talk about a creative deal entry fee. It might include a small amount to the seller, covering arrears, legal docs to the TC, like Tevin told us, that's a transaction coordinator, and an insurance changeover, as well as recording fees. And sometimes, guys, we got to pay the agent. So a property might have a high price, but extremely low entry fee if you're keeping a 3% loan. Okay. Any questions on entry fee or comments?
No.
Okay. So we're going to move to more complex. Oh, go ahead, Stacy.
No, it sounds pretty straightforward. I think what was helpful is that, it can be different depending on, what you're closing on. So that
Yeah.
was helpful.
And it's good that now we have the clear definitions of price, value, and entry fee, because when we go to underwrite these deals, we have to know exactly what those mean to actually plug the right numbers into the calculators. So often we are plugging in the price the seller wants as the ARV. That is not the after repair value. They might be way off. Your ARV may be lower than the price that the seller is requesting, which is usually the case. So don't interchange value and price. Make sure that you're clearly defining what those two are so that you can clearly define what the true entry fee is. So we're going to move to more complex, which is your net operating income. NOI sounds intimidating. It's not. This equation is important, guys. It's income minus operating expenses before debt. If this property were a small business, how much profit does it produce before paying the bank? So if the rent is $2,000 and the expenses are $700, what's our NOI?
1,300.
Yes, it's business. It's not even really a math concept. It's literally how much money am I making in between the rent I'm collecting and the expenses I have every month. People even look at annual and NOI. All you would do is take the $1,300 and times that by 12 if your expenses and your rent stay the same every single month. If you have an Airbnb or midterm rental, your NOI will most likely change from month to month. Super simple, but very important concept, especially as you go into underwriting multifamily, because those are small businesses. They're not looked at as comparables. Those those properties and assets are looked at as the income that they generate. You can have two multifamily properties that sit side by side with the same amount of units, bedrooms, vacancies, tenants. But the one that produces the most money is the one that's the most valuable. It has nothing to do with comparables. We're looking at a business to a business. Okay. What about cash flow versus equity versus velocity? There are three ways that money comes out of these deals, and you have to understand this to underwrite. And then you guys can pull up some practice addresses or examples that you want to go through, and we can kind of talk through these. So there are three ways money comes out of deals, and cash flow is number one. That's monthly income after debt. Equity is your value built over time. And again, we know that that can shift with what's happening in the market. Velocity is how fast your capital returns. Beginners argue about cash flow. Sophisticated investors think about velocity. Who's most concerned with velocity of money? What kind of buyer? Fix and flippers. They want their money that they invested to come back to them fairly quickly.
That's what I was gonna say, but you took the words out of my mouth.
Velocity is important because they're paying points on the money that they borrowed. So just think about a project that has gone completely wrong and now it's costing them more money and more time. They're not just losing money from the cost that they're incurring, it's also the amount of time that's being wasted that they're still having to pay points on the loan. Okay. What about cap rate? Anybody heard about cap rate? That's for
Uh,
multifamily.
yeah, cap rate is like the capitalization rate. Honestly, I always forget it, but it's just like how much, like if every dollar you put in, how many more dollars are you getting out of it? I always forget the exact terminology for it, but it's something around there.
Yes. Tevin has been looking at a lot of multifamily deals, and we can tell. Here's the equation for you, Tevin. It's the net operating income divided by the price.
Yeah.
So it's helping us determine if this seller is way overpriced or not.
Hmm.
And most multifamily buyers know what they want that percentage to be.
Yeah. I think like the sweet spot is anything over, at least from what I hear, is like anything like 8 to like 10 plus is like great. 5 is like abysmal, basically.
And I think that again, the cap rate is going to depend on the asset class. Like you saying, 8 to 10 is phenomenal. That's when it's stabilized. But it also is going to depend on our buyer. If we have someone that's going to come in and add a bunch of value through construction and renovating all of those properties, they want to find a property that's at a 5% cap rate because once they bring it all the way up to speed and to market standards, they have a huge amount of return in between. Stacy and I love stabilized A-class assets with higher cap rates because we know that the property is in sound condition. And somehow, some way, we always find A-class assets that need value add. So people who are looking for straight up value add opportunities, a low cap rate is fine with them because they intend to add value to the property. So it's always going to depend what buyer is at the other end based on what you have in the deal. And it tells you, the cap rate tells you how hard the property works relative to what you pay for it. It is a comparison tool, not a wealth strategy. I hear cash on cash return all the time. The formula for cash on cash return is annual cash flow divided by cash invested. So if I put $50,000 into a property and I make $5,000 a year on that property, that's a 10% cash on cash return. It answers the question for the person, is my money truly working for me? If the cash on cash return is negative, you know that you're in the red on that property. Okay. And I'm going to actually create a PDF with all of this information so that you have a physical document. Yes, Max?
I'm sorry, can you repeat that?
The cash on cash?
Yes.
So it's the annual cash flow divided by the amount of cash that you invested. So if we put 50,000 into a deal and it makes us $5,000 a year, that's going to be a 10% cash on cash return. So 5K divided by the 50K. And that's like, if you get a few $100s a month on, as the gap between your mortgage and what you rent it out for, and it ends up being 5,000 for the whole year. That's that scenario. Is that good for you, Max?
Yes.
Okay, great. So what about debt service coverage ratio? How many times do we hear investors talking about DSCR loans after they finish upgrading a property that they want to keep? Debt service coverage equation is income divided by debt payments. This is how lenders determine if they want to do the DSCR on the back end of you upgrading that property. So here's what it answers for the lender. Can this property survive the loan that we're going to give you? If the debt service ratio is a 1, that means that they're just breaking even. If it's a 1.2 or higher, this is a safe deal. Anything below a 1 is risky. Debt service coverage is about survivability, not excitement. Very, very boring. But it's important. And we'll talk about which investors these are important to. So, like a debt service coverage ratio loan is, again, someone who wants to get a property that needs a little bit of work. They're going to do the numbers and the math in advance to make sure that when they put money into the property to upgrade it, to get it move-in ready, that the money that they put in is going to bring up the appraised value of the property to what they put into it. So if the property, they bought it for 450, they put 50K into it and the value went up to 500,000, most likely the lender will be able to give them that debt service coverage ratio loan for them to hold the property as a buy and hold. This is how you get out of that hard money loan that you got from the hard money lender to purchase the property on the front end and get the renovation and repair costs. Now you have to reverse engineer the math to make sure that on the back end, after the appraisal, which is subjective, that you'll be able to cash out on that property and the lender will refinance out that hard money loan with the 12% interest rate with the debt service coverage loan that's going to be at the market interest rate, which is like a 6.5% right now. Any questions? Because that was a whole lot. Because we about to do an example. So y'all let me know if you have any questions, and maybe this will bring you questions. Okay, so I'm going to drop this in the chat. We have a 3-bed, 2-bathroom property. Purchase price is $220,000. The rent is $2,050. The expenses are $750, and the mortgage is $1,150. We're going to do each of the equations we discussed so that we can make sure we understand them. And when you write this down and write the math out, guys, use it as a guide. So what I did when I first started underwriting, I would find like 5 properties, or I would tell, I didn't have ChatGPT, but I had a book called Commercial Real Estate Investing for Dummies, and it would give me practice problems. And it would say, here's the scenario, here's the numbers. Now you can use ChatGPT to create these fake properties for you so you can actually work the equations. So everybody have what I put in the chat of the subject property we're going to be using the equations for? Okay. So we're stripping this down to 4 numbers. Let's see. Hold on. Okay. So the entry fee is what? We're keeping this super simple, y'all. So if you have, if you can see in the chat what I put, what would the entry fee for this one be?
Is it it's like 1900 for the expenses in the mortgage, but then
For this one, since it's a traditional property,
so it's just the purchase price?
yes, the
Yeah.
entry fee would be 220,000. This would be a traditional investor. We can actually do a creative example as well. So that we're going to keep this one super basic. Entry fee for this would be 220. We can even say, okay, what if we put 20% down in closing costs? I can give you that example too. So say this investor just wanted to bring 20% down. That would be $44,000. Plus closing costs is going to be either 1.5% of the purchase price or 2%. You can do 2% to make your underwriting conservative.
Why is it a difference? 1.5 or 2?
So it's actually state specific. So in Maryland, the closing costs come out to about 4%, meaning 2% on seller side, 2% on buyer side. In Virginia, the closing costs come out to about 3%, so 1.5 and 1.5. So different markets, different closing costs, but that's about the range.
Thank you for the clarification.
Great question, because I would have never thought about that. So the closing costs here at 2% would be $4,400 plus the 44,000 if you did 20% down. So that would be altogether $48,400 as the entry fee if we did it as a conventional loan. Now, somebody stop me and make me break that down or repeat it to me so that we can make sure we all on the same page.
So, and I want to make sure that I have my math right as well.
Mhm.
So the closing costs, it's for the seller and the buyer. Does that include the agent's commission if it's traditional or on
No,
market?
it
Okay.
doesn't. So this would be like a for sale by owner type of property.
Okay.
Yeah. And usually with traditional, but after the new laws, usually the money that the buyer was bringing to the table from their lender covered the seller's agent because the seller was paying, right? So the seller was getting this profit. So all of the commissions used to come out of the seller side. Now that the laws have changed and sellers don't want to feel obligated to pay the buyer's agent commission, the commission can be a factor with the buyer's closing costs. So great question, Tevin. So if we were doing this on market, y'all, you would most likely need to account for some commission there. I can't give any numbers. It just depends on what you negotiate with your agent. Okay. So our closing costs, if they were coming with cash, their entry fee would be 220,000. If they were coming with a conventional loan, their entry fee would be $48,400. Okay, we good with entry fee?
Yeah.
What
Yeah.
is the net operating income? Somebody tell me what that formula is so we can make sure we all doing it the same.
The purchase price divided by the cap rate.
Mm-mm.
No.
Annual cash flow divided by the cash invested.
That's the cap rate,
Oh,
Yeah.
what'd you ask for?
the net operating income. And you have to know what NOI is to even know cap rate. So great.
Well, well, technically the NOI would be, sorry, that my math is wrong. So it would be the rent minus the expenses and the mortgage. So
Yeah.
it's only like 150.
Yes, there you go, Tavin. So it's the rent minus the expenses. So the NOI for this one is $2,050 minus 750 minus 1,150. Right? Now I'm over here trying to do the math. No, it's just income minus expenses. Well, mortgage is an expense to me. Yeah, I think the NOI is only like what, 300 or 200 bucks, Tavin?
It's not even that. It's 150 because the expenses in the mortgage are 1900 and the rent's
Love it.
2050, so it's 150.
Love it. See, this is why we have to do math in real time. And look, knowing that equation was super helpful because if you didn't know it, you could not calculate that for your investor. This deal is super skinny. It's real thin. This is not even enough to cover your monthly reserves in case you get in trouble. Okay. So that's the net operating income. Well, I think honestly, Tevin, based on the definition, the net operating income is 2,050 minus the 750. The cash flow becomes 150 when we deduct the mortgage.
Say that again.
So the net operating income is literally just income minus expenses.
Mm-hmm.
The cash flow brings the mortgage into the equation. So because when we figure out cap rate and all of that stuff, we're determining what kind of mortgage we can pull out. So that's not included in the NOI. The NOI is just the income minus expenses. So what's that number? 2,050 minus 750. 1,300. Is that right, y'all? Please check.
Yes, it is.
Okay. And then the NOI minus the mortgage equals cash flow. And that is 150 like Tevin came up with. Like this is literally the basics of underwriting, y'all. These are the entry fee, the NOI, the cash flow, and then it will help you determine what kind of capital needs to come to this deal based on that. That helps us figure out if getting a mortgage at 6 or 7% makes sense for us to make money on this, right? This deal will work all day if they bought it in cash because there's no mortgage there, right? The NOI and the cash flow would be exactly the same. So do you guys see how financing and understanding how to run those numbers come into play? But you need these bases before you can even get into the financing. I want you guys to memorize these formulas because these are your foundation to underwriting.
Yeah.
Memorize them.
Yeah, because when you start underwriting a lot of deals, you need
Need
to
to
know
know
what
them.
they are. I mean, of
Yeah, no,
course, you
I
can
agree.
always reference them,
Yeah, for
but the
sure.
more you underwrite, you'll know them. Like when I was underwriting a lot, I knew these by heart. But when you don't do it, you can really forget what each thing is and what the formula is.
I just
Yeah.
wanted to make a comment. Memorizing when you're over 50 is can be a little challenging, but yeah, you're right.
No, and I was doing a lot of RV parks, so like I needed to know because that's what those are the basics. So it's like NOI,
Mhm.
what's the cap rate, what's the purchase
Yes.
price? And I'm just like, okay, well, if it's at $100,000, NOI and the cap rate is 8%, like, what how are they evaluating the purchase price and like kind of just confirming things, but also
Mhm.
um, it's like, well, this isn't really a good cash flowing property because of this. It's like if you like just know how to look at something from a broad view without doing the math, it's like, okay, that is or isn't good from the beginning.
Right.
So
This
you
is
can
the,
just avoid a lot of bad and
oh my
a lot
God.
of wasted time rather.
Yes, 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 Tevin. This is exactly what the foundation is for. This is process of elimination. If this doesn't make sense, like that thin little cash flow of 150, unless you know somebody that's willing to take 150 in cash flow or they have cash to purchase it, next, right? Now we don't need to kill momentum by modeling the appreciation, the forecast of the rent 10 years out, debating decimals on the cap rate, and never make an offer. Analysis should create clarity, not paralysis. Do you guys want to try a creative example before we close out and stuff like, or we do Q&A?
Yeah, if we could do a creative one, that would be helpful.
Okay. Okay. I love this because I was about to overcomplicate it. So we're going to use the same property. We're just going to do some different terms. Okay. So boom, here's our updated property. 3 beds, 2 baths. Purchase price is still 220. Rent is still 2050. Expenses, let's actually, yeah, no, we can keep it. Expenses 750. Existing mortgage payment PIT is 1,150. Interest rate is 3.25%. Loan balance is 185,000. All right, and then I'm gonna say here's our entry fee. And then we see if this is a deal or not. Okay. So we remember that the traditional entry fee was $48,400. What is the entry fee now that we're looking at this creatively? The entry fee consists of $5,000 to the seller, $3,000 in closing costs, $2,000 for reserves, and $1,500 in legal and servicing fees. So y'all can just drop the entry fee in the, please feel free to use your calculators. Drop the entry fee in the chat. And I'm going to give everybody time to drop it in because we need to all be doing this together. Boom. Tevin said 1150. Anybody want to challenge Tevin? Or are we agreeing with Tevin?
I agree.
Okay. All right. What about the net operating income? What is that? Max said yes. What's
You
the NOI, y'all?
would it be the same thing, the 1300?
Yes. That's the crazy part. You're going to start seeing where the similarities lie and what the differentiators are when you look at the same property in a different way. The NOI remains the same, regardless if we're purchasing creatively or traditionally.
I agree with Tevin.
Tevin is on fire. Just say, I second that. I third that. All right. So, what about the cash flow?
With the cash flow in that regard, because I can't remember if you said that. Um, Nonetheless, would it only be the 150 though?
Yes, cash flow is the same.
Yeah.
Yeah. What's the big differentiator here? We're going to talk about the required capital type, right? So our traditional deal required a large cash down payment. It required bank approval, W-2 tax returns, strong debt to income, and an appraisal. Our creative deal requires negotiation skills, seller alignment, legal structuring, risk tolerance, operational competence. Capital type shifts from primary cash and credit to primary skill and structure. Creative deals don't remove risk, they shift the type of capital required. Now, why is this may be a deal for someone creatively? Because they're controlling the same $150 a month, but with only 11,500 invested, not 48,000 that they need to recoup. So now, if there's someone that loves appreciation and really wants to get into a deal and they know year 2, 3, 4, 5, that's when we can look at projections. They're going to make 500 or they're going to transition this in year 2 to a rent by the room. That's a whole nother scenario for them. Now this becomes accessible. This becomes something where they just came in with 11,000 and now they have over $30,000 in equity. Whereas that person that paid the 220 got the financing right and had to bring 44,000 out of their pocket and increase the interest rate on this deal with the new loan, they're now overpaying for this loan tremendously. Everybody see that?
Yes.
You make way less money over time when you purchase going through a bank with really, really high financing and having to bring more cash to the table out of your pocket. Any questions or feedback? Anything y'all want further clarity on? Please don't be shy. This is what I'm here for, to answer your questions. All right. I think if you guys don't,
I guess with this, how do you, I mean, obviously the interest rate is important because like where does that kind of come in? Like with the deal itself?
great question, Tevin. So the interest rate is basically telling you how much extra over what the property actually costs you are paying. You can calculate your interest rate for the full year. So someone that has a 6% interest rate is paying 3% more over time over 30 years than someone who has a 3%. Also, the interest rate determines the monthly amount the loan is. So if I have a 3% loan, that same $220,000 property has 1,150 monthly balance. If I have a 6% loan, this same $220,000 property is now $2,300 a month, making me not able to cash flow because the market rent is only $2,050. That's why interest rates kill deals. And that's why most creative buyers don't want anything over a 5 because usually the numbers don't work. So if we had that 6% interest rate, this deal would be dead before we even got to step 2. Was that helpful?
Yeah, it was.
Yeah. So people think about this, Tavin. People were going crazy in 2021 and everybody was getting qualified for loans because the barrier to entry was easier. It was a 2 and 3% interest rate. Now that same purchasing power, they're able to get a bigger house, more land, and then they see their loan now for the same amount and they're like, I can barely afford a 2 bathroom where in 2021 I could have got a 4 bedroom house.
Yeah.
So the interest rate is really important
Yeah,
and it boxes a lot of people out of the market.
it does.
Yes. Stacy, Max, y'all have anything before we close out?
I'm good, thank you.
Could we structure a deal? I don't know if we want to do that streaming or not, but
What do you mean by structure a deal?
so say actually we'll just talk offline. Never mind.
Okay.
Yeah.
Okay. We'll talk about that after this, but I'm just gonna, if Max doesn't have anything, I think this was enough for us to practice and work on this week so that we can build on, okay, here are the numbers, here's the situation. Now let's figure it out by plugging in. Because One thing you probably noticed today was without knowing those definitions, it is very hard to understand what you're looking at. Extremely. So make sure you hone in on those definitions and do some practice problems so that you know exactly where things need to go. So here's your biggest takeaway from week 2. You don't need more spreadsheets. You need better questions. What's the strategy? What's the entry fee? And what kind of capital does this require? Does it service debt? And who is it actually for? If you want help underwriting deals using this exact framework or want us to review your deals live, check the link below. Next week, we go deeper into creative finance underwriting. And remember, numbers are not scary, confusion is. All right, y'all, I'm going to sign out. Tevin, we'll jump on a call right after this. Thank y'all so much for being here on this beautiful Saturday morning. And I already know you guys are going to be rock stars with the underwriting.
Thank you.